Hello and welcome to the Mutual Fund Show. I'm your host, Neeraj Shah. Over the next 20 minutes, we'll talk about 3 or 4 key aspects of mutual funds. Since we are at the fag end of the year, we'll try and focus on what could be done in 2023 on some of the most talked about aspects, which a lot of you have written to us through the course of the year. I won't say just the last one, through the course of the year. So just did a little bit of a simulation as to what is it there is the maximum interest, and then therefore trying to ask this to our 2 experts today. Our experts today, Ashish Mahajan, he's managing partner and CEO of Complete Circle Wealth Solutions, and Gaurav Avasthi, head of UHNI Family Office Private Wealth Management at ICICI Securities. Gentlemen, both of you, thank you so much for taking the time out. Lovely having you. May I start with the first conversation, and that is around how to approach large cap funds, considering that for a considerable period of time now, we've not necessarily seen large cap funds, regular plans at least, beat their benchmarks. And therefore, the options that we had given to our experts was, should they be avoided in the short term from a market risk perspective? Should there be a systematic transfer plan being done in them? Should people focus on low index funds to beat the expense ratios? Or should people choose flexi cap over large caps? Because a lot of flexi cap funds have a large degree of large cap stock element to them. Kshitij, let's start with you.
So thank you, Neeraj, for having me here on show. Always too much to learn from you and fellow colleagues who are on the show. So coming to the first question, what we are talking about the large cap side, I agree with you that there's underperformance vis-a-vis the benchmark, but it's obvious, benchmark I think is more active than your active mutual fund. So benchmark in itself is churning fast. Benchmark in itself is led by a few companies doing well. Like when we reached all-time highs, Sensex out of 30 stocks, 13 stocks have beaten their all-time previous highs, but 17 are still trading. But when it comes to fund, it's been regulated by SEBI that 80% of the stocks has to be in top 100 stocks, and then you are capped by 10% in each every single stock, not more than that. So yes, I somehow feel that rather than going for a pure large cap fund, one can look at index fund or a smart beta fund in index in itself. That's what the strategy should be. Having said that, somebody who's already having a large cap mutual fund portfolio, they can stick around. As there are times when fund doesn't do well, but it's just a cycle. Sometimes your bets will go right, sometimes my bets will go right. So I think the holdings are really very good. They're all large capish. So one can look at holding to those positions. For a new investment, whether an index fund or you want to choose a large cap fund, I think what you said is right. The answer is in the question only. One should do STP only. We are at the peak of market. At these levels, 12 to 14 weeks STP is what we are recommending to everyone, that let's not be in a hurry to park money in mutual funds. You have enough time on your side and take a STP route and look at a low cost product. As rightly said, sometimes all these funds over a period of time, if you save on 1.25 or let's say 125 bips on a year, every year, then still the possibility is that you can be in line with the index fund, or maybe you can beat the index fund by taking a smart beta fund. So that's my submission on how one should approach large cap space.
Okay, Gaurav, good having you on the show, Gaurav, for the first time. Please tell us, how would you approach large cap funds?
Thanks, Neeraj. Thank you for having me in the show today. I think the answer is actually a mix of all the 4 options that you had given us. And typically for the portfolios that that we manage for our clients, the way we are running the portfolios is a mix of passive as well as flexi cap. So typically the way we look at it is that the risk of not being in the market is possibly greater than being in the market. So effectively, if you do nothing, index still gives you that return of 12, 13, 14% compounding over long periods of time. And historically, if you look at especially the last 3-4 years, large cap funds have found it difficult to really beat the benchmark. We were looking at data as of November end, only about 2 large cap funds actually managed to beat the benchmark. So the benchmark returns, I think, close to 40-50% of the portfolio we run through passives. And passives does not necessarily only mean Nifty 50. It can be a mix of Nifty 50, Nifty Next 50. If you believe that the broader markets are going to do better, then you can also look at some of the equal weighted indices. The remaining 50%, typically, we are going through flexi cap mode because we think that the broader markets possibly will do better than large cap. I think the way that we are getting clients invested is largely that you deploy about 80% of the intended allocation over the next 5 to 6 months, largely through an STP route. And you keep about 20% aside, which is more opportunistic or tactical in case you get a correction.
Okay. And in case you believe, viewers, that you have the time and the smartness enough to take advantage of the correction. If you're involved in a full-time job, then I'm sure the recommendation might be slightly different as well. So please keep that in mind. Gaurav, may I ask you, can you cite two examples of an option in a large, so somebody's looking at largely investing in a large cap category. They may choose you may recommend a flexi cap reco. It could be a passive index fund. It could be, what have you. But a couple of examples so that people have some takeaway to go into as they head into 2023.
So typically on the flexi cap fund, we like the Canara Robeco flexi cap fund and we like the ICICI Prudential flexi cap fund. What we are really trying to focus on managers who are growth oriented, because we think large parts of the economy will tend to do well over the next few years. So we are focusing on people who are bottom up growth oriented, and these two really fit the bill for us.
Lovely. So flexi cap, viewers, is the view from ICICI. They are saying do an STP over 6 months and keep 80% of that money in that STP route. 20% of the money keep as cash or a liquid fund or what have you for a tactical opportunity, should you believe that you can take advantage of that. And frankly, it's not that difficult if you put a little bit of mind to it, though I would actually say it's not that easy, but you may find an option to do so, challenge yourself a little bit, read a little bit more, and you might be able to do it as well. Kshitij, to you, again, what are the examples? So you mentioned that you would choose the flexi cap, smart beta, and a combination of things. A couple of examples for the viewers to have a takeaway.
So Neeraj, on the flexi cap side, if you actually see the bigger side of the flexi cap funds, most of them are actually 90% in large cap only.
Large cap.
So my point is, if I actually want to choose to give that delta to a client while getting a multi-cap fund, I will like to go with a focus strategy. I like HDFC focus, and I will like to complement that growth focus strategy with a contrarian view of a value theme through SBI contra. So I like both the fund managers who are managing these portfolios. I like the way they have structured the entire portfolio. Like look at HDFC focus, it's 28-29% on the financial side. It's 9% on your IT side, and then eventually it has added a lot of other sectors which are doing well. Wherein SBI is playing on the infra side, on the defense side, and many other things, and it's little low on your banking as well as on pharma and your IT side. So I would like to complement these two portfolios because I see from here onward where valuation looks, Indian markets have done well, which is a good thing, but I think where valuation looks little stressed, I think there are a lot of businesses on the value theme should do well. So this is one place where I would like clients to look at these two funds, and we are actually liking these funds, and we are talking about these funds.
So these are good for people who want to have a investment in a large cap kind of a portfolio, right? Kshitij?
Yes, these are good for investments. In fact, you'll be surprised in HDFC focus 74% is large cap only.
Okay,
so I'm saying you don't have much option as an industry leader in India right now on the mid cap and small cap space. So you have a lot of these companies.
Got it, Kshitij.
And on smart beta side, I think ICICI low beta is what one can look at. It's a good fund where I see if you actually want to trade the smart side of the index side, then you can add 5-7% allocation to that fund.
Got it. Gentlemen, thank you. This solves a large portion. I mean, this is fairly useful information for a lot of people who are kind of putting in that question. Now, the other question is, if people, both of you mentioned, right, that do an STP. Kshitij, you said 12 weeks, which is 3 months. Gaurav, you said 6 months. Therefore, there is a chance of or a probability of a volatility or a volatile period or maybe a corrective move as well. So should an average investor invest in small cap funds in the first half of 2023? So the options, of course, that we gave viewers to them that can continue or start an SIP, but because it's impossible to time the market, or avoidable because better to start after the dust of the global slowdown settles down. 3, invest in lump sum because small caps will do really well in India, or D, do an STP? Gaurav, I'll start this with you.
Sure. Thanks. So, if you look at the small cap figure, small cap obviously has underperformed large cap over the last 1 year. And even if you look from a valuation perspective, it is possibly the cheapest index among mid cap, large cap, small cap. Having said that, obviously small caps are far more volatile. So lump sum is never really a great idea unless valuations are very, very compelling. So while valuations are cheap, but they are not that deliciously compelling right now. So STP makes sense. I think provided that you have a longer term horizon of 3 to 5 years for small cap, I think if for the investor, he'll be better off if actually there is a correction, that it will help him actually get better valuation. So from our sense, small caps are not overpriced. They are probably the more attractive part of the market, but the valuations are not so compelling that you do a lump sum. You do an STP, and we think you'll make reasonable returns in small caps over the next 3 to 5 years.
Okay, so don't avoid them, but do an STP. Don't go out and buy a lump sum. Simple advice, right?
Yeah,
perfect. Gaurav, what are the funds that you might be looking at?
So here, what we look at is the Nippon Small Cap Fund and the Kotak Small Cap Fund.
Any reasons for the same?
So typically, both these funds have long track records. We really love the style of the fund managers. And if you look at the category today, most of the funds are becoming large because of previous performances. I think we would rather go with people who have seen the cycles and have the ability to really manage the larger funds.
Okay. Kshitij, again, same question to you with the same options.
So I will not like to recommend small cap to average investor. And obvious reason is that when you buy a multi-cap fund or focus fund, or let's say large and mid-cap category fund, or a mid-cap pure fund also, you get a small cap exposure. And I agree with what Gaurav has said, that it comes with a lot of risk. Somebody who's looking at 7 to 10 years of horizon while parking its funds can actually look at participating in a small cap or mid cap fund. Sometimes the gestation actually becomes very long. If you remember, Neeraj, 2017, small cap index has given a return. I'm talking about the index, not the fund, has given a return of 56%. And mid cap was 48% now. 2018, the new regulation came, ICICI came, and we have a SEBI regulation about the fund categorization. And that year, it was minus 67%. I'm saying, and then it took almost till 2020, post first wave of COVID, then small cap started moving up from August, September onwards. So I am of a view that it's meant for people with a high risk appetite and a long horizon while investing. So I will like that. Yeah, I like a category. I have my participation in small cap. But I have long horizon for my small cap allocation. I don't mind keeping it for 10 years. So I think you get exposure there, and Neeraj, the type of return which it generates, 2-3% delta over, let's say, large cap or a multi cap over a period of time. I think for that, the type of risk which you take is much high. End of the day, you have to evaluate what type of risk you are taking to allocate fund and type of return you want to generate. If you believe in power of compounding, if you make 15% also, your work is done. You make 2 times in 10 years. So I'm saying, I think I will like to give small cap to people, and we give which have a little high risk appetite.
Okay, so you mentioned you have exposure to small cap funds, but you park there for 10 years.
Yes.
Let's assume there are people who want to do that. Gaurav, Kshitij, what is it that you would recommend? Which funds?
So we like SBI small cap and Kotak small cap. Both funds we like very much, and for obvious reason. One is there's a consistency of performance over a period of time. Size is very adequate, because in small cap, if you reach 14,000-15,000 crore, and let's say if you like some idea, for one idea I need to buy 750 crore. That type of liquidity is not available in markets. So, and third very important reason, especially for SBI, they have on numerous number of times they have stopped subscription to their funds. Right now also you can't park lump sum whenever the fund size go high, and whenever they see an opportunity in small cap, they open it for some time. So that's what I like about fund houses, where they are very clear that yes, if they don't see appetite for growth, they don't accept the money. So these are the 3 reasons. And if you see in small cap space also, the fund with bigger sizes over last 10 years, I will not quote anything, but one can go and check, has given 15-16% of the morning. For funds with adequate size or in this category is able to deliver over last 10 years 18-20% of the morning. So I think that's one fund which we look at.
Got it. Thanks, Kshitij, for that. third point, now we shift focus because a lot of people, of course, need debt allocations, and we've done numerous shows on this. But as we wrap up 2023, I thought it was good to revisit and try and understand from you guys both about what should a person do if the person wants to make debt mutual fund investments, what category, with a presumption that the person is able to invest for over 3 years so that the person also gets the indexation benefits. So she's comfortable putting in the money all through the 3 years, or in parts, or lump sum, in whichever category that you may recommend. Now, Kshitij, let's start this with you. What should she do?
So it's very interesting time for fixed income, Neeraj. The curve is flat from 3 months to 6 years, 5 years, if you actually see. You get the same type of yield from 7.15 to 7.45 in that bracket. And interestingly, if you see the benefit, right now somebody is coming in and stay there for 3 years, 3 months, you get 4 indexation. So whatever money which you are seeing as a return will be a tax-free, because you get 4 indexation benefit, then you get long-term capital gain benefit. So that's how it is. So I think somebody who wants to put in lump sum money right now on the fixed income side, and someone who's at a high tax bracket, this can give you 10.5%, 11% pre-tax. If you actually add up the tax part, and you're getting post-tax 7%. You can look at short-term fund or corporate bond funds where there's a 100% AAA allocation which is there. One can look at that. And if you want to put lump sum money over a period of time, then ask me. We have done this calculation at our end that over 5 years rolling returns, pick any 5 years tenor. Gilt fund has not given less than 7% return. So rather doing a RD where you get 6.5% and then you pay tax as per the tax slab, just do a SIP in a gilt fund, or let's say a 2028 or 2027 maturity IDFC Crystal Gilt Bond Index Fund. So I'm thinking, or Bharat Bond Fund from offers like Edelweiss. So these are few funds which we like, which come with a very low expense also. In fixed income, if you are working on the expense side, let's say the yield is 720 and you're at 5 to 15 plus expense, your job is done.
Sure.
Post tax you make 7%. So this is what we recommend, that lump sum, look at short term. For long, if you want to park for 3.5 years, you want to do a SIP, look at a gilt fund, or let's say 2028 or 27 maturity gilt fund, you can do a SIP there. And if you're looking at parking for a short term, then look at ultra short term fund category or a money manager category. There also, as we said, if you want to keep some powder dry for equity, you are making 6.5%, 7%, which is killer.
Okay. Oh, well, so view as a combination. If you indeed want to keep 20% cash as tactical for equity, Kshitij is recommending you could actually use his advice. Yeah, his advice on the debt market side as well to make that slightly better return. Gaurav, how would you approach this? Again, as I said, I'll just lay out the ground rules. She's happy to invest for over 3 years so that she gets indexation benefits, and she's happy doing an STP, SIP, lump sum in whichever category you recommend. What would you do? Or what would you recommend? Sorry.
Yeah, Neeraj. So I think the world has changed over the last year in fixed income, and while we were in a rising rate environment, largely we were staying with passives because we thought that is the best strategy. And typically we were doing the fixed tenor plans or Bharat Bond ETFs or index funds. But our sense today is with the inflation readings that have come in India plus in the US. Our sense is that most of the bad news is already priced in the price, and from here incrementally interest rates should, in the medium term, actually should start looking down. When you look at a scenario like this, then we believe that active funds actually start doing well because there are multiple opportunities to really like alpha in the portfolio, from credit spreads to to taking duration calls. So today, currently, the way we are positioning debt for clients above 3 years is that you put about 35% in passive funds, like some of the funds that they mentioned, like Bharat Bond or fixed tenor plans, PSU, SDL kind of portfolios. Today, you are roughly getting about gross of 735, and as Sidharth mentioned, you'll get post-tax about 7%. We are putting about 45-50% in short-term funds, typically right now. So that we don't really take too much risk on the duration side. But tactically, we are putting about 15 to 20%. We have started putting in dynamic bond funds, where we think that the fund managers can really take a call on longer duration. And in a falling interest market, typically these funds start doing well.
So you're doing
typically
SIP kind of for a systematic
STP.
investor
So I
or
think you should, you should do an STP over the next 3 months, pre-April. So, you get the indexation benefits.
Yeah,
there is
that's
still some volatility in the air on fixed income. So, you can do a 2-3 month STP, but close it before April to ensure that you get the indexation benefits.
Okay, great. And what kind of funds or what are the funds that you would recommend?
Typically, on the short-term fund, for example, we have Nippon and Kotak with us. On the dynamic bond fund, we are aligned right now with IDFC, now Bandhan Dynamic Bond Fund. Typically, again, these are fund managers that we have tracked and worked across cycles. And from a mindset, both from a credit point of view or from a duration point of view, we are very comfortable in terms of how they take the funds.
Got it. Thanks, Gaurav, for that. Kshitij, I missed out on asking you about the fund recommendations. So for the recommendations that you made, what are the funds that people can look at?
So for 3.5 years, they can look at short-term fund, and which is ICICI short-term fund we like, HDFC corporate bond fund. These are the two funds we like at our end. And one can do their due diligence at their level, but we like these two funds. Then for Gilt Fund, one can look at SBI Gilt Fund and IDFC Crystal Bond 2022, 2027 or 2028 maturity Gilt Fund. That's what they can look at. At the same time, on the ultra short-term side, they can look at Tata Money Manager Fund, one fund which they can look at, where we like this fund. And Bharat Bond Fund is there with different maturity. So beauty of fixed income is if your tenor is matching your maturity of the portfolio, then there is no risk of market movement, because eventually you are maturing as the paper is maturing. So your market risk, mark to market risk in between might be there, but while the maturity it's not there. So decide on the funds which you want to park and just map it with the maturity of the paper in which you are parking. So this is what we do at our end. Depending on his maturity, we just map it to the tenor where they are doing. Yeah.
Okay. Jamin, we are running very short of time, but I have to ask you as a finale, what is it that people should do for an ideal portfolio? Now, assume the investor is an average investor of average age, average income, average saving capability, average investing capability, because we can't tailor make it. So you're kind of doing it at an average aggregate level, right? So Gaurav, I'm starting with you on this one. Create an ideal portfolio, percentage allocated wise to equity, within equity what, debt within debt what, and if it's a hybrid, then hybrid.
Sure. So, a normal average investor, I would really take as a 50-50, 50% debt and equity to really, cut his risk as well as, get reasonable return.
That's standard across times, or is it specific for this time?
So typically, at this point of time, see, normally based on how valuations play out, this may range between 40 to 60%. So
okay.
right now we are far
50-50.
more neutral where valuations are.
Sure, please continue.
Yeah. So at this point of time, the equity part of the portfolio, the way we are really looking at it is that you would have about 60% exposure to large cap, close to about 15% exposure in mid and 15% in small cap. We have added about 5% in international funds, and tactically at this point of time, we have also added about 5% in in a mix of gold and silver funds, because we think that the dollar index is really peaked out, and this may, the precious metals will also do well over the next couple of years.
Okay.
Debt, as I said in the last question, is typically about 35% in passives, 3 to 4 year kind of maturity, about 45 to 50% in short term, and the residual 15-20% in dynamic bond funds.
Got it. Kshitij, what about you?
So I would like to give you a 60-40, 60 on the equity side, 40 on the debt side. I see that your return, irrespective of you being little low on risk, being average savings are there, your return should be in the range of close to about the nominal GDP. So I would like to have him around 11% of overall returns, where I see that a mix of balance fund in equity side, index fund and a multi-cap fund. I will not like to give him an aggressive portfolio, because he might, because markets may go down south while he started investing, and he might end up saying that मेरे लिए तो FD ही ठीक है. So I don't want him to be in a situation. I want to give him a little safer bet on the equity side also. And on the fixed income side, as said by Gaurav, it's a mix of 3-year to 5-year maturity, what I will like to give. And it's a very sweet spot for people who are participating right now in fixed income. You can make 6.5-7% on fixed income. And with this type of portfolio of balance index and your focus fund, you can generate 13%, 12.5-13% there. So average of close to about 11% is what I am targeting, 10.5 to 10.8%, where client can get return post-tax on the overall portfolio.
Got it. Gentlemen, it's been lovely. It's great learning and great service for a lot of people who might be rethinking or might thinking about how to go about redesigning their portfolios if they need to. So I'm sure this will help all of them. Gaurav, Kshitij, thank you so much for joining us and giving us your thoughts.
Yeah, thank you so much, Dheeraj, for having us on the show.
The pleasure was ours. Viewers, thanks for tuning in.